my goodness. Are we back? Can y'all hear me? Is anybody there? What's up? Uh, First thing and foremost, in this stream, I have to make sure that this audio is working. No mic setup. We had some technical difficulties in the last stream. I was kind of giving a little bit of context on a lot of the latest topics as far as how things are going within these markets. But up front today, I'm just like, look, let's just start off smooth. Like, can we get on the same page? Is my camera halfway tilted the right way? Or can y'all hear me? What's the deal? Hope everybody's doing good, man. We're gonna do a little late night stream. I've been thinking about a lot of what it's like to live a life of an investor, like a real investor. Like, what does that really look like? And there's a certain amount of fortitude that you have to have if you want to make it long term. Long term should be something that's constantly in your brain, because if you plan on living a long life, right, if you plan on being here for another 20, 30, 40, 50 years even, you should think about how I can do something today to help myself in the future. Sometimes what that help looks like is to take a break from staring at charts and markets every single day. Maybe a month, maybe two. Sometimes you need to get your life together, learn how to make really good income, and spend a good 6 months, 8 months, and then come back to the market. That's kind of what I was expressing in the last stream is, instead of getting overwhelmed of why your altcoin is not up 10x, 50x, the biggest thing is, if you increase your principal, you may not even need a 50x for that to be substantial for you. Why? Because you have a big P, not a small p, in your equation of compound interest. That's what we're going to lean into today. Is I'm going to thoroughly teach anyone who watches this video how compound interest truly works. Not in theory, but how it truly works. In the description below, I left the actual formula for those that, are a little bit more analytical and you just want to read something. You can read it, and please remember it. Remember this formula until the day that you are no longer here. Why? It's because those that truly understand compound interest can take advantage of it. It can work for them. Those that don't understand compound interest, it's going to work against you. Now, when we hear the word interest, I'm going to be talking about this concept. You want to think about your investment, right? Your portfolio growth. Not just like, hey, how much interest did I get on the amount of money that I put in, but like, what is the overall percentage increase through time? So, yes, I'm hoping that I can come back onto YouTube and just give you guys just education. There's nobody else on YouTube that is talking about this, especially in the context of investing in crypto. You're going to see some super generic compound interest is, they're not going to break stuff down. We're about to go like a real deep dive. This may be, I don't know how long it'll be. It's late. It's 11 o'clock where I'm at. Sometimes you got to put in the dark hours, man. Like you have to put in these hours to really get a thorough grip and understanding on what you got to do for your life. And if you're not compounding knowledge, it's going to be hard for you to compound anything else. Like relationally, if you don't compound how to go about your relationships the right way, most likely they're not going to be long-term relationships, right? Or if you don't learn during that relationship, it can be anything. It can be relationships. It can be your job. Like, if you just do your job the same exact way from this first day that you get there, the chances of you actually elevating in that company and getting raise after raise after raise is going to be slim. You'll be at the bottom of the totem pole for 20, 30 years when you could have been, at that time, maybe VP of the whole company, if you learn how to compound your knowledge of what to do the right way within that industry, within that job. So compounding is something that applies to everything in nature, everything in life, even habits. You're compounding either good habits or bad habits. For example, are you the type of person that it is just like impossible for you to wake up anytime before 6 a.m., 7 o'clock? Is 7 o'clock too? Oh, is that too early for you? Oh, you can't get your days. Yo, if you really want to get somewhere and you need a little bit extra time in your day, wake up earlier. Wake up at 5:45 if you need to. If you need to do whatever you need to do, right? So if you learn some good positive behaviors that can help you, that can help compound the rest of things that matter to you in your life. But if you're someone who, quite frankly, I'm just being honest, I teach a lot of people with the way that my life is currently. I do a lot of teaching offline, and I talk to people, and I inspire them. I'm just like, success is one thing, and basically it's like I'll say we're talking about the precursor to success. Some people always want to talk success to money. Success is not only money. Success is not only getting the outcome that you wanted. It's if you're going so. There's a guy named Earl Nightingale. He is someone who had a lot of influences as far as like the creative space in communicative speaking and professional speaking. Long time ago. One thing that he said was success is the pursuit of a worthy ideal. So not an idea, but ideal. Something that you envision to be worth your time. If you're making effort towards that, then you are a success. That's a decent definition. Now the precursor to that, something that I tell my students that I deal with, and something that I just have adopted, and something that I've even said maybe once or twice here on YouTube, but I'll reaffirm and say it once more, is individually, personally, for you, what the precursor to success in its essence is doing the boring stuff that 99.7% of people don't want to do. So, for example, actually sitting down and breaking down how compound interest really works in real terms. Most people don't want to look at this formula and try to apply it to their investment strategy or even their life. They're just like, whatever. But that's what success is. Like, it's not how much money you got. It's like your ability to look at yourself square in the mirror and say, hey, am I going towards something that's worthy in my life, something that I care about? Okay, if I am, what am I willing to do for that? Am I willing to wake up a little bit earlier? Am I willing to read a book so I can learn how to get basic comprehension? Do I know anything more than 8th grade math? Right? These little pockets of information can help you personally. Hey, do I know how to carry myself emotionally when prices drop 30, 40, 50%, whatever the case may be? And do I have a strategy for that? So success looks like preparation, truthfully. A lot of times in life, what I find, even in my professional career as a professional football player, I did that for quite some time. What I find is those that have success in certain avenues, in certain ways, especially on the field, but especially in the meeting room, everything at the end of the day comes down to two things: preparation and training. Like, if you're a salesman and you're trying to sell cars or sell a product, whatever the case is, you need to learn how to do a pitch. You need to learn how to close. You need to learn how to feel the interaction. KYC, know your client at the end of the day, but then know how to ask for the money, not be too abrasive, but at the same time not be too timid, because they're not going to trust anybody that seems like they don't know the product that what they're selling or the service that they're trying to give, right? So like a lot of things just come down to training and your ability to utilize that training for your personal growth, to then help turn that personal growth into some type of monetary premium that you can now ask for because you have the experience and training. So preparation, experience kind of go to things hand in hand, what I find. Now, so when we start to look at this formula here, compound interest, you'll find that there's going to be some things that you're like, oh, okay, that's pretty basic. But there's some things that's like, very innovative way to look at it. And I'm going to try to reveal that stuff to you today. But overall, let me talk to you guys. The market is, the altcoins, you got to understand. You're going to spend, investing the right way is being bored most of the time. The euphoria it never outlasts the amount of just boring time within a market. It doesn't matter what you're investing in. You're going to have a lot of boring time. The key word that I'm just displaying over and over is time. So that's one of the major facets of the compound interest equation that we're going to look into. But let's scour over to CoinGecko first. We'll look at some basic things. We'll then look at some on-chain data. Very briefly, we're going to spend all of maybe like 5 to 10 minutes on this. And the rest of the stream is solely going to be about us understanding and quantifying compound interest and how we can basically use that to level up, not just financially, but in all the areas where we want to see improvement through time, growth through time. That's what we're talking about. So let's do it. Really quick. How are y'all doing in the chat? Anybody there? If y'all are not watching this live, if you're catching on the replay, go ahead and leave something in the chat. And, we're going to kick this thing off right, man. I'm getting back into it, getting back into the YouTube. Once again, you have to take some time. You can't get overwhelmed and overconsumed with just data and information. Like, go get some real world skills and focus on that for a little bit. And then take all that extra money that you got and learn how to buy the dip. So that's currently that's what I did, and I was in a transformational time period in my life. Like, beautiful things, man, happened for me over this past, year, but especially like the last 6 to 8 months, man. I'm a father now, right? So it's just like, man, that's been a beautiful thing for me to compound knowledge and time there. Like one thing is like I'm pretty present. So I'm sorry, YouTube, but it is what it is. Like, you know what I'm saying? You know what I'm saying? I got to take care of responsibilities, and that's always going to be first. But as things kind of progress and routines get built, yeah, go ahead and hop back on here on YouTube. So, I'm talking a lot. Let's just get into it. Let me show you guys this. Let's get into the sauce. So, all right, check me out. So right now we have, and let's move me out the way a little bit. Right now we have CoinGecko. Overall crypto market cap, we're finally back above, 3 trillion. Man, just wait. In due time, that's going to say 5. It's going to say 6. It's going to say 10. If it takes 5 years, if it takes 10 years, great, is what it is. But understand what that does. Compounding for you, compounding for your future growth and what you want to have as far as your optionality within your finance. Just let it compound through the years, man. So Bitcoin, 94K, about to touch 95K over the last month, up 14%. Nice rebound. Ethereum a little bit more lackluster. Is what it is. Solana back up 18% over the last month, $148. Man, bought that dip, man, in the Patreon. Literally, what is this, April 7th and 8th and 9th? I'm like, yo, you guys, turn the DCA switch on. Let's go. Bought some sub $100 Solana, feeling really good about that. It's nice to be up about 48 to 50% under a small window of time. But guess what? That entry, that DCA is going to compound greatly because of the cost point, because of the cost basis. Is being at a relatively nice local low. We'll see what that looks like in 2, 4, 6, 8, 10 years. Sui up 48% over the last 30 days. Very nice. Sometimes zooming out is the only thing. I don't even want to look at anything in the last hour, the last 24, or the last 7 days. It's irrelevant to me, to be honest. Right now. Don't mess with any of this. Don't mess with that. Don't mess with that. I don't mess with that. Don't mess with that. Render. Yes, that's in the portfolio. Up 29% in the last 30 days. Smaller position, but in the portfolio. So I like to just come and check and say, hey, how has this month been going? Like, the more you start to just focus on the longer term time scales, the easier investing becomes. I'm going to say that one more time. The longer that you start to focus on the longer term time scales, so monthly, quarterly, yearly, the easier, the more fruitful, and the more, how you say, I guess you can say, just plain reasonable way to invest on all fronts, emotionally, psychologically, from the knowledge base even. It just is, it's such a smoother process. So we're not even going to worry about these three. But over the last month, we got some positive movements after a lot of boringness, and we'll see if there's some follow through. With all these tariffs, oh my gosh, tariffs. Then things kind of dwindle down, and things seem to be not so bad. Probably, a good qualitative look. I've been watching Bloomberg, not every day, but about 3 to 4 times a week. And Bloomberg, we're talking about news from around the world. They're looking at treasuries. They're looking at what China's doing. They're looking at what Japan is doing. Looking at what we're doing here in the United States. They're looking at businesses, small and large. They're looking at stocks, equities. They talk about crypto here and there. They're talking about the Bitcoin ETFs. A lot of different coverages on many different topics and all that kind of stuff. Tariffs being the thing that's scaring everybody. But all that fear is slowly going away. Like the futures market for the SP 500 has been slowly trickling up each and every week. I like to watch, especially like on a Sunday. Little piece of information there. It lets you kind of know how things will potentially open up for that week once the bell opens on Monday. So, anyways, yeah, things are looking okay for the last month. That's all. So, on-chain data. Couple things. Short-term holders are always what matters in a bull market. How we want to look at it from a momentum standpoint even, or if we want to look at the SOFR. But let's check it out. From a momentum ratio of the MVRV, the short-term holder cost basis is this blue line. The metric is reading either positive or negative momentum. Now, with that being said, what we can see is the time periods where we have some momentum going below the short-term holder cost basis. That's when people start to freak out, especially people that are, just new to crypto or don't have a real good understanding on how to hold something from like January 2016 to, we're talking April of 2025, 9 years. They just don't understand that concept. It's just like chill out and just hold. And no matter all these fluctuations, you're going to make your money. And the number gets even bigger because time, one of the most important factors of the equation, is going to give you that compound interest or that compound return. But anyways, it's like, these underthrows are times when you want to start to come look at the market. This is what a savvy investor will do in a bull run. We've been in a bull run since 2022, December 2022. It's been a very nice, constructive move higher. I'm going to have to do a stream of like a classical analysis on Bitcoin probably sometime in the next 7 days or so. But with that being said, if you also want to look at it from the standpoint of just regular MVRV, not so much momentum, the flat out standpoint of looking at the standard deviation above and below, like anytime, for example, we come below the short-term holder cost basis, and this is one whole standard deviation below it, so we have like that local period here, that local low. Oh yeah, like these are great opportunities. We've had this, we're talking about 3 times essentially in this bull run, where it's just like when you start to actively buy your crypto during these time periods, your cost basis is going to be significantly better than if you did not buy during these time periods. And so what does that do? That decreases your risk during the bull market and through the rest of time, especially if we do have a bear market at any point in time here in the next 6 months, a year, 2 years, whenever it may be. Why? It's because you're positioned better than a majority of the market, meaning you won't face so much downside action fear later if you have the balls and the cojones and the structured mind to go and take action when everybody else is fearful in the bull. You suffer much less in a bear run if you do what you got to do in a bull run when people are fearful. So we had that opportunity here. Like I said, April 7th, April 9th, that first week of April. Even now, still decent. We're still right here at the midline. We're not in any type of expansive period. So we're people that have been holding Bitcoin for 180 days or less are in nice significant profit. They're at like break even now. But the key thing is, typically, if we can have a nice break of this, we'll have a nice period of time where we'll have some standard deviations above it. and elongated time of price going up as well. So fun, fun, fun for all the people that understand some of this basic on-chain data. So um, if you're in the Patreon, you definitely took advantage of this because I said, hey, go ahead and trickle in that DCA, and you don't have to do it all in one day, but definitely take action. And that was called out on April 7th, I believe. So if you've done anything between now and April 7th, the last 21 days, the next 6 months, 8 months, a year should be looking relatively positive for your portfolio from a percentage gain perspective. All right, so that's out the way, y'all. Now let's get into some of this nitty gritty. Here we go. So let me make this make sense, and we're gonna do it just nice and slow. So I'm gonna make myself just a touch bigger. I bet. All right, so for those that are watching now and for those that watch this later, what we're looking at is the equation for compound interest. So I've put together another document that's going to give some examples, some real world understanding of this. But this is the equation that you need to know if you want to. I'm just be straight up honest. If you really want to get wealthy, you're not going to save your way to wealth. It's not going to happen. You need to have your money working for you. You need to potentially maybe have a business with people working for you. The key thing is working for you. In a savings account, money can never work for you. So that's the first thing to know. Secondly, choose an asset that can have a rate of return, not something that is depreciating through time. So cars, typically not assets that are going to make you return unless they're like specific collector cars, stuff like that. But how do you use your money? Are you going to just put your money into the indulgence of vacations, food that's going to be, very tasty in the short term, but long term leads to diabetes 30, 40 years from now if you just do it every single week? Are you going to just sit down and watch Netflix and go to the movies all day? Or maybe get a gym membership. We've got lots of options of what we can do with our efforts, our time, and our money. Once again, everything compounds. Now, when we're talking about, in terms of finance, compound interest, here's the formula. So we have A equals P multiplied by 1 plus R divided by N, right, to the square roots of NT. So let's break it down. A, what is A? A is your portfolio value, your future value, okay? That number through time, as the months and the years go by, should be increasing. P. P is your initial investment, aka your principal. How much of your own money is being put into this asset through time? 1 is being thrown in there because you have to put the 1 in there to be able to get your multiples, right? So 1 plus R, which is the rate of return. So that's going to be the key thing. When you're looking at investments, you have to look at R as rate of return, not interest rates. Like interest rate would be something where it's just like, hey, I have a CD. I leave $1,000 in that CD for 1 year. They're going to give me 6% return. So I'm compounding 6% on my $1,000. Okay, cool. There we go. I made $60, right? So that's not what we're talking about. Rate of return is your percentage growth through the year from that investment, okay? N, number of times compounded per year. So once again, when we're looking at investing, the way that you can flip that on its head to kind of understand that a little bit easier is how many times did you invest through that year into that asset that's going to produce a rate, like a rolling rate of return for you. So are you someone that just invested one time? Like you got your, let's say your P, your principal. You start off with $1,000 January 1st. And then from there, July, halfway through, you invest it one time. All right? So that's not helping you on your compounding number. So the frequency of your investment is going to matter. And we'll talk about that here in a little bit. Now, You close that parentheses because it needs to do that math first. Then you multiply it by your principal. But then the key thing that adds jet fuel to this whole thing is to the square root of NT. So once more, you take the number of times that you invested times time, and you square root your number that you got, after you do all the other multiplication to the left here. This is power. This is not linear. The fact that we have anything that is squared means that now we're no longer thinking in linear terms. Now we're doing things in a compounding nature. When you talk to your average person, I'm pretty sure that they could figure out, okay, what is 8 plus 8 plus 8 plus 8? They'll be like, okay, 8, 16 plus 8. Okay, we're thinking 24 plus 8, or whatever the case may be, like basic math. Then ask them, tell me 8 times 8 times 8 times 8. Okay, that'll be 8 times 8, 64 times 8, and they're like, they're stuck, right? We're not meant to think in exponential form as the average human. And so therefore, that's why a lot of people don't like to invest for time, because they can't understand how the benefit really trickles in the more years that you put into your investment. Like, that's how it's done. And the better your rate of return, the faster that you can compound that as well. We'll talk about the 3 jet fuels that make you get to a large number faster when we go through the document. But you guys, screenshot this, save this, or join the Votes of Crypto, the Patreon. I'll probably leave a link in the description, or I'll probably put a link in the next video if it's not in this one. I'm not really too worried about trying to get so many people in there. I want people in there that want to learn, that really want to try to get some value, not just try to make a quick buck. But with that being said, when we're talking about this is something that you got to recognize, because it's going to play in every facet of your life. It's going to play into your investing especially. So I have a document where I've laid this out. We'll spend, essentially maybe a good 15 to 20 minutes on this. We'll soak it up, and we'll say, okay, well, now how can we apply this to our investment in crypto, stocks, whatever you got going on. So, let's trickle over there and get the job done. So let's see here. Boom, 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 boom. Yes, sir. All right. So now let me make myself a little smaller, because now I'm too much in the way. So boom. All right, check me out. So understanding compound interest and dollar cost averaging. Dollar cost averaging is a version, a type of way that you can do compound interest, but it's not the exact same. So let's discuss, right? We already know the formula for compound interest. Once again, P, your principal, multiplied by 1 plus your rate of return divided by the number of times you invested, to the square root of the number of times you invested multiplied by time. Okay, so we know these factors. Okay. A, so this represents the total value of your investments or loan at the end of the investment period, including the compound interest. So once again, the reason why I inserted loan in that verbiage is because, like, we gotta understand, either it's working for you or it's working against you. So every time that you borrow money, understand you got compound interest working freaking against you. And this is going to delay where you'd like to go financially in the long term. It just is. Borrowing money, don't overdo it. You're going to have to sometimes. I get it. It's like the costs of things are just outlandishly high. Like just for a house, most people are not going to be able to just afford a house. But outside of a house, if you are in the grind phase, the growth phase of your life, typically I say, and it doesn't take a long time here. Like we're talking 10, 15 years of just good, adequate, hard work, compounding knowledge, doing what you got to do, not going overboard with debt. 15 years. If you can do that, you can solidify a great life for yourself after that. So if you're somebody that is 20, by the time you're 35, in your 30s, I'm in my 30s, you can be living an incredibly, incredibly beautiful life for what standards that you may be setting for yourself if you follow the process. Don't accrue a lot of debt. Keep your expenses low. Invest consistently through the 15 years as you make more money. Stay consistent. So future value is what I just explained. Your future value, net worth, can be dramatically affected because if that money goes to paying something off that you didn't have enough money to pay for, when it should have been going to building up your nest egg and building up your snowball that can roll faster downhill the larger that it gets with time, you're going to end up with not much of a snowball if you accrue too much debt. So therefore, there ain't no future value for you. That's just me just being brash, just basically explaining what's happening to most Americans, unfortunately. You ain't got no future value. Why? Because you didn't understand this formula on how it works against you or how it works for you. Anyways, P a principal amount. This is the original amount you invest or borrow. It serves as the base. So with everything, you need a foundation. Like, for example, if I'm somebody, and let's say I've got a good job and I've been able to save, let's say $20,000, and I just don't know what to do with it, right? If I start with that $20,000 and I keep trying to do my DCAs through this next 15 years or whatever the case is, do my investment, grind, and work, put this as a priority amongst other things in life, but make your finances a priority for 15 straight years and do your investment, and you'll see what I'm talking about, right? You'll find out that you're going to have a nice feeling on your end number. Why? Because you started with a nice noteworthy principle versus the person that had the $20,000, left it sitting in the savings account, and then let's say, I'm going to trickle it. I don't know. I'm a little nervous. I don't understand compound interest. I don't understand stocks or crypto or anything like that. I'm going to just start off with $100 as my principal. And then just stick with maybe like $100 DCA for like 5-10 years. And then they're like, okay, well, I think I'm kind of getting it. And then they try to trickle a little bit more towards the end. They're messing up their equation. Why? Because their principal ain't a large number to multiply off of. Remember, look, go back to you have to multiply your P by the rate of return. So if you are getting a rate of return, but you have a small P, not making a joke, you know what I'm saying? You ain't going to end up with nothing big later, right? So if you start with a bigger P up front, you're going to get to your result faster, okay? So once again, we'll talk about the jet fuels. That's one of them. Rate of return. This one is another one. This is the sauce. This is the amount of return that your investment makes through an annual basis. So this is stated yearly rates expressed in a decimal or percentage, and it gets divided by the number of compounding periods, right? So compounding frequency. This is how often the interest is calculated or added to the principal. All right, and then so once again, in DCAing, it looks a little bit different because it's like a rolling return because you're buying something at a different price. I'm assuming like none of this stuff is going to stay the same exact price every single month or every single time that you dollar cost average or you do your buys into your asset. But if it's like fixed, right? So something that's like getting interest on like a fixed amount, then yeah, it's like, sometimes, that gets multiplied on a monthly basis or a quarterly basis or a yearly basis, so, that'll change your in. Or sometimes, like, for example, if you're staking and you're staking, I don't know, Solana or whatever the case is, that's going to, compound on, it's like your APR versus APY, right? So it's going to compound every single day versus just, quarterly every 3 months. So anyways, like that part is the piece where in the formula it can get a little bit of pushback as far as the understanding, but when it comes to DCA, I'm gonna give y'all some examples of what we need to understand with DCA because it's a type of compounding. So, time. This is the total duration your money is invested because compounding works exponentially. Time has a powerful impact on your financial amount. Okay. So let me give you guys in order the 3 jet fuels that you need to understand. the number one jet fuel that you need to have a big number is the longer that you've invested, the time, the higher your number is going to be. That's just flat out the most important factor. Because, for example, I could have a lot of principal to start with. Let's say I start with $1 million, right? I get a nice rate of return of 20% for, let's say, a year. I got $1.2 million. Boom. My compounding is done. Let's say I want to, now I want to go spend the money and and keep it out of the investment. I don't want to keep compounding it. I want to take all my winnings and go live my life. Then that's where you stop, 1.2. But what if you do that 20% return, and let's say you don't even invest any more money annually, rate of return, and you do that for 10 years, with a much higher number. Let me give you an example of that. So 1.2, or you just delay a little bit of gratification, you put your time in for 10 years. So let's ask Chat GPT, for example. So let's talk. Hey, can you calculate something for me? I have $1 million and I'm expecting to get a rate of return of 20% over the next 10 years. About how much will I have in my portfolio after the 10 years? So let's see, right? 1.2, or let me do my time. Let that compound. You see that, like that square root? That's what we're looking for, right? There's the formula. We just talked about this. Our principal plus the rate of return, time. 6.1. Now, you can take 4% of that a year and live off of that. And that number is going to keep going up. So, okay, give me an example. What is like a 4% draw of this $6.1 million look like every single year versus a 4% draw of $1 million every year? You're going to see the difference of the type of lifestyles that you're going to be able to live here in the United States, Canada, UK, wherever you're at. Like, we're going to look at these comparisons. It's kind of hard to live off of $40,000 in the United States now, but especially, because you'll get this money within a year, right? It's going to be hard. You're going to have to go back to the drawing table, But in 10 years, it's pretty reasonable to say, I can probably live off of $250K a year if I just stick to the script and put that time in. So I'm hoping this example helps you understand why time is the biggest factor, right? Rate of return is going to be the second jet fuel. So let's talk about it. The second jet fuel, which is important, the rate of return. Because we talked about an annual rate of return of, we're talking 20%. Now, you can get that with a mixed portfolio of, Bitcoin, some Solana, maybe some Ethereum, and some stocks, right? Maybe some tech sector, buy the MAG. So the ticker MAGS, that's going to give you the top 7 tech company, or top 7 companies, the Magnificent 7, in an ETF. So it's just like you get, these major players, you get the price movement and volatility to the upside for those 2 years, right? So you can get a blended portfolio, and over 10 years, you can get that 20%. That's not too hard if you pay attention. But for example, Bitcoin by itself, the last 6 years, over 50% compound annual growth. 50%. Solana over the past, we're talking 4 years, even a little bit higher. So, even if you're conservative, 20% looks pretty nice. And even if we can use smaller numbers, that's cool too. Instead of, $1 million principal, let's say we start with just $1,000 or 10,000, right? You're still going to have nice outcomes. So the rate of return does matter, because let's say, okay, if we are savvy, we kind of know some of these things that we know about, right? Think about that, $3,300 a month or $20K a month. Big difference. 10 years of time. Hey, So let's change things up. Instead of 20% rate of return, let's double it and make that 40% rate of return. So in crypto, if you just stick to the strip, you might find yourself in this category, 40%. Look at this. Now, we got $28 million now, okay? All we did was double the rate of return. We didn't double the principal. We didn't add any more time. But here's the key. The reason why this is like, I don't know, this is just as powerful as the years, right? We went from 6 to 28. We doubled the rate of return, but we've significantly, like, we just, went, what? We're talking almost 5x on the overall number from just doubling the rate of return. Super, super key. So what does this mean? Find the good assets and stick with them. Tried and true. Bitcoin, the last 16 years, if you do the calculation, it's nuts. I know a lot of people weren't in Bitcoin 16 years ago. But even from, like I said, 6 years ago, we're talking like 50% plus compound annual growth rate. So once again, even if that dwindles down to maybe 40 over the next 5 years, this is what we can do to our portfolios with something like Bitcoin. But we've got some other things that are going to compound possibly just a little bit more. These smaller altcoins, if they can get their foothold and if you could stand the test of time. And we're not talking about super small. We're talking about, like I said, Solana. Pretty large player, but yet a little bit earlier on in its cycles, right? So trying to give y'all some vision. I'm not saying y'all got to go out and buy a whole bunch of Solana today, but that's part of what my strategy is. I've got several different legs of the strategy, right? But rate of return, very, very key. Look at that number there, much bigger. If you notice in the equation, there's no n. Why? Because this is not a scenario where we're adding to our principal, basically doing monthly DCAs through the 10 years or weekly or bi-weekly DCAs or anything. So that's the third jet fuel, is your frequency, okay? So the amount of times, how many times are you putting your hard-earned money into the investment, into the asset, okay? Very key. So if you're somebody that's expecting to get a large number, you better you better either start with a large principal and just let it ride and do your time with a nice rate of return. But the thing is, if you're somebody that doesn't have a large number to start with your principal, then what you have to do is the frequency of how much you invest needs to be accelerated. Like, instead of just being like, oh, I'm just going to invest like once every, 2-3 months. Like, you should be like, okay, if I start off doing every 2 months, I need to do every month. And then when I figure that out, I need to then try to do every 2 weeks. And when I get that figured out, I need to try to invest every single week. If you got smaller amounts of money, that's the jet fuel that's going to help you out in this scenario, is the frequency. So let's look at that. Now, the number is going to get even crazier because let's say, right, if I'm somebody, in this scenario, that if I started out with $1 million, for example, which is a crazy amount, and I like doing things with big numbers because it's fun. But let's look at it like this. Okay, now to this equation, keep everything the same. Let's look at it two different ways. One with the 20% rate of return annually for 10 years, and then the other with 40% rate of return for 10 years. But introduce into the equation investing $1,000 a month during this time period. For both scenarios, run that calculation for me. Okay. So, if you got $1 million to start with, $1,000 a month would be reasonable. Just like, for example, if you've got $1,000 to start with, if you want to do like the same ratios, like $10 a month, would be about the same. So, right, it pumps it up. Update it. it adds a little bit more sauce, 6.5, 29 million. And let's just make sure we ran it right. So show me the equation. Just make sure we got it right. Give me how much I would have if I start with $1 million. I have a rate of return of 20% a year for 10 years. And along the way, I invest $1,000 a month. What would my end value be? Just double check. And that's just with $1,000 a month. Okay, so yeah, 6.5. Pretty good. I mean, truthfully, the ratio should be $10,000 a month, because if you start with $1 million, you might be comfortably be able to do $10,000, right? But I don't want to freak us out. But yes, that jet fuel is good. Let's do something a little bit more reasonable, okay? So instead of $1 million bucks, let's go to something more reasonable, like $10,000, right? So as we can see, those are our numbers, right? The rate of return, very important. 40%, it's just a double, but if you can get it, that's what you want. You're going to get a much bigger number. It's your principal, super important. So let's do this. Let's get some more reasonable numbers. So let's do, oh, hold on. Let me not do the voice chat. We got to go back to this one here. My bad. Okay. Okay, let's do some more reasonable numbers. Let's say I start out with $10,000, okay? With that being said, I, once again, invest $1,000 monthly for 10 years. And my rate of return is, let's do 30%, right in the middle. What is my end value going to be? So just plain consistency. Don't worry about trying to buy the low, buy the high, because this stuff gets improved, by the way. It gets improved if you're able to really concentrate more of your money during the bear market, because your rate of returns are going to typically be higher if you just only solely focus on concentrating a lot of your stuff during the bear market. But once again, after 10 years, are you going to be somebody that just because here's the thing. Let's compare. Let's say I don't invest and I have $10,000 and I just save $1,000 additional into my savings account. I do that for 10 years. How much will I have? Look at the lives financially. Who has more financial strength at this time? The saver or the investor? That's decent, $130,000, but there's a big difference. There's a big delta in between those two. And that's the thing. 10 years. These numbers look even better if you add more time. So let's do this over 20 years. Let's say I start with $10,000. I invest $1,000 a month. I get a modest 30% return annually. But now we do this for 20 years. What am I looking at? So when you double the time, you think your number's going to double here? You think it's going to be 1.4 million? No. It's going to get increasingly exponential when you double that time. If you're somebody that can do 10 years, great. If you can do 20, you're killing it. What did we just do? We just more than 10x the price just from doubling the time. So just like rate of return, where we were able to 5x the price from doubling the rate of return, when we double the time, we get a 10x on the multiple. So y'all need to remember that. Here's where the value is in this stream. $10 million. 20 years. So if you're 21 years old right now, you're watching this by the time you're 41. Once again, break that down. Take 4% from that per year. And that's still going to grow, by the way. But you take 4% of that a year, you're going to live a nice life. At 41. Things taken care of. Kids taken care of, right? College paid for. Going on whatever vacation that you want. Buy the car that you'd like. You can afford that monthly payment.
You know, buy your mom a house then, you know, whatever, or give a lot to charity. Give a lot to your local church. Start a foundation. Build another business out of it. Build something that can give back to your community. This ain't all just about you. Money is not just for you to hoard, y'all. Like, once you get to this amount, what I would maybe have y'all consider thinking about, this is what I think about all the time, is like, what can I do to help the people around me in any shape and form from this blessing that I've been able to receive due to the diligence that I've had. 20 years, if you look at the average work life, is more than 20 years, right? The average work life, you're talking about 40, 50 years in most cases. A lot of people start at 20. The retirement age for you to even get Social Security is what, 62, 65? So you're looking at 42 years. So I don't even want to put those numbers in. I don't even want to put 40-something years of compound interest, compound growth. It's going to freak you out. So, and like I'm saying, we're starting off with $10,000 doing $1,000 a month. Now you're like, man, I can't do $1,000 a month. Then what you need to do outside of watching this stream is you need to go become an expert at something out in the workplace, out in the marketplace, right? And just keep your expenses low. You don't have to have all the newest stuff. You can find a way to save some money. If you got kids, it's a little bit harder, but it's doable. Trust me, it's doable. Y'all can do it. Go make that side business that's going to pay you just that little bit extra, that extra $600, the extra $500, right? Get intuitive. Learn how to use ChatGPT like how I'm doing here. Learn to build some systems. Just learn something. Create value for yourself. You got to keep adding to your principal. This is key. So we're breaking this down. Let me just kind of throw this into DCA terms. So real world example, like, we're saying, let's say you invest $100 twice a month into Solana. That's 24 contributions per year. Each $100 becomes its own compounding stream, essentially. Like, each one is going to have a different multiple to the time. Starting at the same time, it was a positive. So you're effectively creating like a stack of many compounding interest calculations rather than just one large one. So that's what happens when you DCA. So the formula changes a little bit. But nonetheless, it works, right? Because $100 from 12 months ago grew to, at 20%, compound growth rate, which, we can see, sometimes in a year, Solana has gone up hundreds of percent. So what are we even talking about? 20% versus 100%. But if we want to get an average over time, that's going to drop down to not hundreds, but, once again, 30, 40%, which is really good. So, but you do that, compared to 6 months ago, right? So if you have $100 invested 12 months ago, you have a certain return. But if you do that over, let's say, 6 months ago, you have a little bit less return. And so you add that together to your equation to give you like that rolling return. But nonetheless, the compounding nature stays the same. So, we're not even talking about, rewards. And it's up to you. I personally am not really doing too much staking, but once again, like staking, like that extra 8% that you might be able to get from staking your Solana, which I would never suggest staking all of anything. But if like you got like, if you trust staking and you're good with the validating system and all that kind of stuff, personally, I feel like if you're new within crypto, if you're new within the last 4 years, you shouldn't even be touching staking because you haven't built up your nest egg yet. Like, only stake stuff that you're willing to say, hey, if I lost it, I wouldn't be tripping tomorrow. That's what you should stake if you are. Or, for example, if you just want a little extra on top through the years, post-chain, become a validator. I got this validator sitting over here every single day. Yes, post-chain price ain't been so great, but through the next 5-10 years, I think there's a good chance. With that being said, I'm getting an extra 10% added to the compound growth of the price appreciation to get me to where I'm trying to go. So, get a validator, to get that extra little bit of yield. But basically, this is what we're talking about, okay? Traditional compounding interest is simple. Invest once, let it grow. We're not doing that. So we want to DCA. This is more dynamic. The key thing is we're trying to invest consistently. Every investment compounds independently, but with DCA, you get multiple overlapping growth curves. So understanding how time and frequency interact is going to help you harness the full power of the compounding. What you have to do is, in crypto, the number one thing is time, jet fuel. Number one thing. Number two is the consistency. How often can you invest? Try to make it as often as possible and let time do its thing. Don't worry about just, I only want to buy the low. Like, if you don't have a lot of money, you just got to get your ass going. Excuse my language, but you just got to get going. You got to get this thing going. And then 3, yield, aka the rate of return. Do your due diligence and find the things that are going to be here for 10 to 20 years. Sometimes that's not the super low cap stuff. It's not the most sexy thing. But maybe you're looking for things that are immutable, things that you can't take away. That's why I like post chain and a lot of what that community has to offer. But things like Solana, which once again they're about to have an ETF. Things like Bitcoin ain't going away. Things like Ethereum ain't going away. They're gonna be here. And just ask yourself, can I get a modest 20% rate of return for 10, 20 years? If the stock market can do 10%, I'm pretty sure Bitcoin can continue over the next 10 to 20 years, do at least 20%. You mix in some things like Solana potentially, who knows? So we may start to carve its way out over the next 4, 6, 8 years as well, right? You find yourself at a nice growth rate of, who knows, maybe 30%. If you do it the right way, 40%. It's not crazy. Why? We got Bitcoin as a prime example. Prime example. Compound annual growth rate. Let's run it really quick. Hey, what is the compound annual growth rate of Bitcoin over the last 6 years? The key thing to remember, the price is about $94,000 as of today. So we're just going to say take 6 years. The number gets even better with time with Bitcoin because obviously the price is much lower even 10 years ago. So 46% over the last 6. Not bad. Okay, what about the compound annual growth rates over the last 10 years? And then we got to go double check this to make sure this number is right, because that can fluctuate some things. But over the last 10 years, 70% annual compound growth rate. Come on now, that's beautiful, right? So I'm not saying that we're gonna get that. What I'm saying is I think we can be somewhere in between like the 25 and the 45% range if we have a nice balanced portfolio of cryptocurrency and some really good stocks within the stock market, right? You ain't got to go all in on crypto. You can have a little bit of some stocks too, just to help you sleep a little better at night in case you don't like the volatility to the downside. But yeah, that is something that the more that we soak that in, like keep looking at some of these bigger numbers, let that soak in, sleep on it, and wake up tomorrow hungry to say, hey, how can I start compounding things in my life to help me? All right. So that's what I have. This was a nice 1-hour stream. It's good to be back. It's great to be back. And I really look forward to continuing to compound this information, this knowledge with you guys on our journey. So, with that being said, y'all be easy. And yeah, I'll catch y'all on the next one. All right. Peace.